From the financial centers of the world, this is Bloomberg Markets with Alix Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Tuesday, May 24th. Here are the top market stories we're following for you at this hour. Snapping back to reality. Snap cutting its outlook. Abercrombie & Fitch slowed their ad spend. Shares sink and drag social media and advertising stocks with them. We're going to get the read-through on growth. And on the verge of stagflation, Bob Prince, co-CIO of Bridgewater, says markets are under-discounting gains in consumer prices. More on the consumer and the economy with Bank of America Chairman and CEO Brian Moynihan. And the ECB's rate hike debate. Christine Lagarde says central bank won't rush to withdraw stimulus. Others push for a 50 basis point hike. More from our exclusive interview with the president of the central bank. From New York, I'm Alix Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, it's a really ugly way here in the stock market. We're down by over 3% now for the NASDAQ 100. The first gap down you can definitely blame on Snap, but this gap down is more eco-data related. The Richmond Fed Manufacturing Index, -9. Manufacturing PMI, services PMI in the U.S. coming in much weaker than estimated.
Yeah, it's the services number that really caught my eye. You've seen it over here in Europe as well. The UK services number slowing down really rapidly. The Eurozone holding up, but for how long, given the cost of living squeeze that is coming through. Then we get new home sales as well. They come through light as well. 591,000 versus 749 was the expectation there. We're down from 763. That 763 has been revised sharply to the downside as well. The month-on-month number is negative 16.6. The prior number revised to negative 10.5. The new home sales market, much more exposed, of course, to the inflation debate that we're having. What's happening with labor? What's happening with materials? Take a look at what is happening with lumber, steel. Everything you have to put into a house when you're building it is going up right now. And that is certainly looking like it's going to be slowing things down a little bit because it's going to have an impact on price. Then you throw in elevated mortgage rates as well. So all of this coming together, I think, showing signs now of a slowing housing market in the United States. Is this what the Fed wants? Well, judging by the activity thus far, you've got to assume that it is. So, yeah, I think, Alex, today we have two factors, really. I think they are related. I think what's happening with Snap and what's happening with the ad market is related to, look at what Abercrombie & Fitch is saying today. It is going to slow down its ad spend because of what is happening with its costs and its consumer story going forward. So, yeah, I think it's all related, and it doesn't paint a particularly positive picture. So
let's get to that question of the day. What does Snap signal for growth? And then we add in all the economic indicators from this morning as well. Michael McKee, Bloomberg International Economics and Policy Correspondent, and Romy Bostic, co-host of Bloomberg Markets. The close. Romy, I just want to start with you because Snap signaled something about advertising spend that we heard echoed with Abercrombie & Fitch. And I'm wondering what your read-through to the broader market is from that.
Oh, I think it's a big read-through, a big macroeconomic read-through. Look, remember the old days. I'm old enough to remember when ad spending was sort of one of the key barometers here of a slowing economy or a stronger economy. I think what was surprised a lot of folks about Snap isn't just the slowdown, but the idea that this company came out with earnings just four and a half weeks ago, where it kind of gave softish guidance then. What changed here over the past 4 weeks that caused it to come out and make this public announcement as it did last night? I think when you see how fast the conditions are deteriorating, and more important, how fast consumer confidence and sentiment is deteriorating, I think that's going to have a material impact, not just on ad spending, but on a lot of consumer spending overall. And it's something that I think we should all be paying heed to.
It's clear companies, Mike, are looking for ways to save money. The middle of the P&L is being squeezed. Margins are under pressure. How useful and it is, to Remain's point, advertising spend as an indication as to the health of the economy?
It's a useful indicator, but it's not as accurate as it used to be. It used to be you would look more towards a increase in ad spend early on in a recession as companies geared up to try to get people's attention. That the whole process has become a little bit more truncated. I think what people are failing to think about, though, here is the difference between some of these companies. And I don't want to talk about the social media space in general, but if you just look at Snap and a chart I brought along here versus Best Buy, and Best Buy their numbers weren't great, but they were better. Snap has never had a positive return on capital, and their profit margins have always been negative, whereas Best Buy has always had a positive profit margin, and their profit margins are staying up even if they are down from where they were pre-pandemic. Actually, they're about where they were in terms of return on capital. So there's not a differentiation between companies here that is perhaps important.
Well, that's such a great point, actually. And Romain, I feel like Savita Subramanian of Bank of America saying just this, that like these are the recession the pandemic names that are now feeling this pressure, not necessarily the services names. I'm just wondering if that narrative holds.
I mean, it holds water, but remember, there's been this rotation kind of going back and forth, and the big concern here is that as services picks up some of the slack, once services weaken, is there going to sort of be a swing back to goods? And I think the short answer right now is no, probably not in the short term, at least based on what we're getting, not only out of the economic data, but more importantly, what we're hearing from the companies themselves. I think the forecast that we got from Snap yesterday, and you sort of put that and overlay that over the forecasts effectively that we got out of JP Morgan and Jamie Dimon 24 hours prior, I think it's kind of telling that you have a bank here that has, I think, a really keen bird's eye view of the economy, basically saying, well, yeah, there's some clouds out there, but nothing is really sort of going to fall out of the sky. And then you have a company like Snap, which is obviously in a much weaker position than a JP Morgan is, basically saying things aren't all that well. And I think you're seeing the drag down now on a Google, on a Amazon, on a Roku, on a Trade Desk, on a WPP. And I think it shows you that investor sentiment right now is in a position where they don't really want to wait around and try to sift through it all just yet. It's rather just head for the door and then wait for the smoke to clear.
Romain, let's just talk a little bit about the consumer, to Jamie Dimon's point. Jamie Dimon talked about it. I've heard the CEO of Bank of America talking about it. The consumer balance looks fairly good right now in terms of their bank balance. So they still have a lot of the money from the pandemic still to spend. That is still out there. The problem lies with companies not at the top line, it lies with the cost line in the middle. This is where the problems are showing up right now. Abercrombie's a classic case in point. Higher than expected freight, product costs. Looking forward, we expect higher costs to remain a headwind throughout at least year end. We continue to reduce our promotional activity. They're trying to offset one with the other.
Yes.
This isn't a consumer crisis. This is a profitability crisis in the consumer sector.
It is, and you're seeing that not only with a sort of a smaller name like an Abercrombie & Fitch, you're seeing it with the bigger names. We heard the same thing, more or less, out of Target, out of Walmart. We're going to get Nordstrom earnings after the bell here in the U.S. a little bit later, and I think you're going to hear the similar story. I mean, look, this supply-demand imbalance that we've been seeing in the consumer space because of the pandemic, there was always this idea that the supply would somehow catch up, that the labor would somehow catch up, and now what we're seeing is deterioration on that side, and then, of course, that ends up feeding through to the demand side as well.
Okay, Mike, so when you take a look at the data from today, it's the preliminary read for May, but nonetheless, I mean, 53 for services, 53 for the composite, but the manufacturing still holding up, and I guess I wonder how long that can last in the data.
Well, there's a certain amount of momentum in the economy here, and that's what Mary Daly was talking about yesterday, the San Francisco Fed Bank president, who thinks the economy will avoid recession because it has enough momentum that it won't go to zero. And we are starting to think in terms of percentage changes as far as the way investors are looking at the economy, when maybe we want to look at levels and where we were pre-pandemic. We've spent a lot of money. Now we come back down to where we were spending beforehand, and that's going to look bad in comparison. But then you get a couple of quarters beyond that, and you start to see growth again. So it may look like a recession in some of the returns on Wall Street, but we may not get there in terms of the overall economy.
Yeah. Worth noting as well that the S&P went into the pandemic at what we thought was elevated levels, but it was below 3,500. So if we're going to remove some of that pandemic froth, then we've got a long way to go. Mike McKee, Romain Bostic, great stuff. Thank you very much indeed. What have we got coming up for you? We are going to be speaking to Omar Aguilar, CEO and CIO of Charles Schwab Asset Management. That conversation coming up. This is Bloomberg.
there's a real risk to any of these social media platforms that are dependent on advertising revenues that they're going to face a near-term headwind. The other near-term headwind for tech, most of it's been priced into public markets, and actually we see a lot of opportunity, which I want to come back to. But the other thing that needs to play out before we get a full recovery here is private markets, which have not yet discounted the bad news that public markets have. That's still a couple of quarters away.
That's Katie Koch of Goldman Sachs while speaking with Bloomberg earlier at the World Economic Forum in Davos. And that really takes us back to the question of the day, which is what does Snap signal for growth? And I think you can kind of add that into the weak economic data that we also got at the top of the hour. Let's ask Omar Aguilar, CEO and CIO of Charles Schwab Asset Management. It's about $658 billion in assets under management. Omar, the read-through from Snap, the read-through from the weak economic data, what does that tell you of where we are with growth?
Well, it's clear that the economy is decelerating globally. We have started the year with that, several headwinds going into 2022 that is transpired. And you put that into context of all the transitions that we're going through. So we're going from, very strong economy to a decelerating economy. We're going through no inflation to high inflation. We're going to zero interest rates to increasing interest rate by central banks. We're going from, plenty of liquidity in the market to a lower liquidity. So overall, the market seems to be just adjusting for that. And at the same time, we're going into very accelerated late cycle. And that, to specifically answer your question, when you have that deceleration of cycle, you see, profits started to reduce, the profit margins started to compress. And of course, a lot of what we're seeing is a reduction in capital expenditure. A lot of the activity that you see in some of the stocks recently is a reflection of, the potential for future discounting mechanism of what investors think will be the reduction in capital expenditures, whether it's advertising, whether it's extra consumption by consumers, but in general, there will be a reduction of capital expenditure as the economy slows down.
Where are we now in that process? Because what I'm trying to figure out right now is whether or not we are seeing a consumer slowdown. And a lot of the evidence points not to a consumer slowdown, but a profit slowdown. Companies are really struggling with margins. Like Snap's an example of that in many ways. You look at what Abercrombie's saying today. We had Target, we had Walmart. Company after company is basically coming out and we're saying we're being squeezed in the middle. And while a healthy top line is being maintained, it ain't dropping down to the bottom line. How much further in that process do you think we've got to go?
Well, it's a great question, Guy, because when you put it into context, we're going from, again, yet another transition, going from an economy that was driven by good consumption. So people were buying appliances, they were investing in their houses as we were going into the COVID years. And then that transition is going into the services side. And in many cases, the consumption that we see for consumers is a sort of a pent-up demand that was sort of stuck for 2 years. And now everybody seems to be just moving into that service sector. Now, what happens in this transition process, as you see that, is companies are starting to just figure out how much of that pricing power they still have. And a lot of what you observe in those companies' outlooks, it's a reflection of their reality of, how much longer they can expand that price, push to the consumer. On the one hand, the realization is that, yes, there are certain parts of the economy that is probably not going to end up in the same place as they were pre-COVID. And at the same time, when you actually see that, and specifically from the recent results of some of these companies, it has to do with the fact that those price valuations and those asset prices that went up during the pandemic, those 2 years, are obviously the ones that are suffering the most, especially as they realize that the economy has transitioned towards the services side of the part.
Okay, so if you look at the chart right there, say NASDAQ 100 or just broad tech, I mean, it's dropping like a stone. Like, these are going to be ugly charts, right? How can you still sell those sort of pandemic winners? Can you still sell at these levels, say tech growth?
Well, the process of actually trying to get in or get out of the market is a very difficult one. Trying to find when is the right time to buy or to sell is just a difficult process of timing around it. The big part of this becomes, and again, the equity markets, and specifically when you see charts like this, become a discounting mechanism for the future. And in many cases, what it does is that if you put into context the long-term trends, you put into context the gains that people have had over the last several years, together with the drops that we see this year, overall the trends, create that volatility that is just trying to extrapolate into the future. And in many cases, is just how much of these is, highly dependent on interest rates, how much the company or the sector is affected by potential higher inflation and how much of the economic slowdown and the potential reduction of consumption will affect the company down the road.
Omar, let me ask that question from a different point of view. We went into the pandemic at what we thought at that time were fairly punchy levels. The S&P was trading below 3,500. It's still trading at 3884 right now. How much more downside is there? When you talk to clients and they say, I want to get out, what do you tell them?
Well, we have clients that have asked us both, sides of the questions. Do I get out now or do I get in now? And we continue to emphasize that market timing and trying to call the bottom is something that we just don't think it's viable or even advisable.
Okay. That's fine. But if you are in a situation where markets are under significant pressure. If I'm as a client and I come to you and say, look, do I get out at this point? What are you telling me?
Well, what we basically say, use this dislocation, Guy, to try to rebalance your strategy towards your long-term objectives. This is the time where you need to stay invested. If you go back in history and you look at every single one of the drawdowns that have been of this magnitude, when you put it into context of the economic, and every cycle is different, a year later, 5 years later, 10 years later, most of the time, stock prices tend to go up on average. And what that happens is using these market dislocations to try to rebalance, because you're right, the market is dislocated and there's a lot of changes that have going underneath. And this is a time where you can use this market volatility to rebalance your strategy towards the long term.
So if many were diversified into tech heavy, where do you want to be rebalancing? And Guy mentioned this earlier, but relatively positive comments from Jamie Dimon yesterday about the consumer. We're going to hear from Brian Moynihan in the next hour. Do you need to go to banks? Is it energy? Is it bonds? I mean, we're seeing a very chunky move on the front end right now.
Well, the good news in all this area is that if you think about where we were, the dynamics across asset classes from just even 2 weeks ago, where everything was going down, and nothing, and correlations were very high. Right now we're seeing a little more stability in the bond market. We see a little bit more of that fluctuation. We haven't gone above 3% on the 10-year. And that's at least a little sign that things are starting to just become a little more stable, at least on the fixed income side. When we get the questions of where to go now, we're clearly, all the signs were in the late cycle. When you think about higher interest rates, tight labor compliance, reduction in capital expenditure, all that signs towards late cycle, signs. And of course, in that period of time, the sectors that tend to do best tend to be cyclical. So we still have the energies, you still have the REITs, you still have some of those that tend to be more immune towards, inflation. And at the same time, some stability that comes from defensive, like staples, utilities, healthcare. Now, that being said, there are still rich valuations you need to consider. And obviously, there is opportunities to rebalance across areas that have been obviously, down more than others.
Front end, the bond market's having a pretty good day. Omar, we've got to leave it there. Things are moving pretty fast right now. Omar Aguilar, CEO and CIO of Charles Schwab Asset Management. Coming up, Snap plunging. It's well below its IPO price. The last number I saw was down circa 40%. There you go, 41.5%. We're going to have more details on what we should be taking away from it, both from a company point of view, a sector point of view, and an economy point of view. This is Bloomberg.
Stocks really picking up some steam to the downside. Snap dropping like a stone, seeing its biggest intraday decline since it went public back in March 2017. That is really weighing on the rest of tech and the whole equity market as well. Brian Fitzgerald is Wells Fargo's analyst. He joins us now. He's lowered his price target for Snapchat from 48 to 27, but maintains an overweight rating. Brian, why the overrate if you just lowered your price target by 20 bucks?
Yeah, look, I think what they were pointing to is a macro situation tearing faster and further than expected. We just got that guidance less than about a month ago, but there's no company-specific problems. While there is some overlap with TikTok, Snap engagement is intact. Stories are constructive from what we heard last night. Snapchatters remain highly engaged in the content with close friends. They are substituting spotlight content for more distant acquaintances. But the engagement is intact, the audience is intact, and so we think the long-term opportunity is intact with that continued strong engagement.
The stock's trading at 13. Brian, this is a massive, massive move for a company that was a darling not that long ago. As Alix says, you've gone 48 to 27. We're trading 13 right now. What is the right price for this stock? If you were to put a number on it right now, is it that 27? Or do you think it's actually kind of the risk is to the downside? Let's put it that way.
Yeah, it's a great question, Guy. I don't think the risk is to the downside. At our price target of 27, that's trading at 36 times next year's EBITDA. They're growing that EBITDA between 21 and 24 at 37%. We got no specific color in terms of, was it weakness on brand, direct response? Was it specific verticals or regions of concerns? You're right. Several stocks are down in sympathy. Pinterest, Trade Desk, Facebook, Google. It's hard to tell if the market is getting this right or overshooting, throwing the baby out with the bathwater. I think what we wanted to highlight is there's a potential that a broad ad recession is emerging. One of the last things you want to cut, that advertisers cut, is that bottom of funnel performant direct response advertising. And for Snap, that's 45% of the business.
So Brian, give me a perspective for Snap and its peers, for example. So if it's a macro environment issue, right, and all these social media stocks are going to get hit with that, are there ones that can manage that a little better than Snap? Or is there an advantage that you see that Snap might have?
Yeah, it's a great question. So I think the pain that we're starting to feel, and we just got back from marketing in Europe internationally, is, and Google pointed to this on the quarterly print, it's international branded campaigns are softening. You don't want to be exposed to somebody who's too international. You don't want to be exposed to somebody who's too high up the funnel and branded. Twitter, if it wasn't for what was going on with Elon Musk and that drama, is the one that is most exposed to top of funnel branded and more exposed to international. But again, there's a separate situation that is maybe putting some insulation around that stock. In terms of what would fare better, companies that are bottom of funnel, performant advertising, search-based, click-based, CPA, CPC, those ones are fairly insulated.
Yep.
And then companies that have, a model that goes beyond just simple advertising. So Amazon with AWS, Google with their cloud business, those will provide insulation as we go through a recessionary environment too.
Brian, yes or no? Would you buy at 13?
Yes, we would buy at 13.
Brian Fitzgerald, Wells Fargo, Senior Equity Analyst, sir. Thank you very much indeed. Some more headlines coming out of the ECB, this time from Kazakh. The ECB should not rule out a half-point increase. That's the second voice today. Holtzman out earlier on talking about the same thing, saying a 50 basis point hike would be appropriate. Bank de France saying no. The president saying no as well. President Lagarde, that is. Coming up next, Bob Prince, Bridgewater Associates co-CIO. He says the US is on the cusp of stagflation. We're going to hear more from him next. This is Bloomberg.
One-third of the total regasification capacity of the European Union is located in Spain. 50% of the LNG storage at the European Union is located in the Iberian Peninsula, which is the problem that we are facing, the lack of interconnectivity. And that is why I think it's really important to invest in those interconnections to provide also from the south of Europe alternatives to the Central and Northern Europe.
That was Spanish Prime Minister Pedro Sanchez speaking earlier to Bloomberg at Davos, saying his country could provide an answer to the shortfall in gas supplies from Russia. Let's get back to the U.S. markets here. We're trying to bounce off the lows. We're an hour into trading. Bloomberg's Abigail Doodle is tracking all those moves. Abigail?
Yeah, Alex, trying is the key word. The S&P 500 off the lows, but nonetheless deeply in the red, down about 2%. Again, though, off the lows, the NASDAQ 100 doing worse, down 3.2%. Before taking a look at the social media tech drags, let's take a look at the Haven bid, because some investors are taking this selling in stocks after 2 up days for the S&P 500 very seriously. You can see a big bid for bonds, that 10-year yield in 12 basis points. The yen rallying against the dollar by more than 1%. So again, this is a classic risk-off days. day with stocks lower and haven assets higher. As for the chance of whether or not we see a move higher, who knows? Anything is possible in this environment. But one thing that we do know this year is it's very difficult for the bulls to keep it together, because every time that there's been a 1% up rally, generally there's a not so great rally reaction to the downside. Some of the bigger declines back in late April, early May, sharp declines. And then, of course, last week down 4% after a decent rally. Right now, we are looking at the possibility of an even bigger decline than that 1.7%. This was put together a little while ago. As for the cause behind all of this, it has everything to do with Snap's bearish pre-announcement to the downside, talking about the macroeconomic environment. And you can see that this stock down an amazing 39.5%, off of the lows a little bit, but nonetheless the worst day on record. And also very dramatic about it is just a month ago, they put up a solid quarter. They were not talking about this macroeconomic weakness having to do with inflation, rising interest costs, the Ukraine war. So a very sudden deterioration in the ad spending of corporations out there. When you put that together with the fact that Meta earlier this year, down 9.3%, said that Facebook users, that they are having a harder time attracting them, it's a double whammy, because it's both the users and the corporations relative to the ads. So you can see the big weakness here also for Alphabet and Amazon. One of the keys for the market, of course, all of these mega weights, but I would always love to look at the Apple chart to see what's happening here. And this is a critical chart. This is the weekly chart of Apple. First of all, you can see this beautiful uptrend over the last 10 years or so. And you can also see that when it typically goes below the 50-week moving average, it tends to catch some support on the 100-week moving average. That's exactly where we're at right now. Apple right now is above that 100-week moving average, telling you that the intermediate, the serious buyers, the intermediate term and serious buyers, they're hanging on. They like this stock right now. So, Guy, this is 12% of the NASDAQ 100, I think about 8% of the S&P 500. If the Apple buyers hold in here, it suggests that maybe there's some kind of floor for the market. Of course, we've been looking for this near-term bounce, and it really hasn't developed. But this is a very positive sign, or at least a supportive sign for the markets with all of this fluctuation and volatility.
I think these markets need all the help they can get, Abigail. Thank you very much indeed. Some positive noises, at least on one stock. Abigail Doolittle, thank you. Let's turn back to the macro, which looks pretty ugly right now. The US apparently on the verge of stagflation, and the markets are under-discounting gains in consumer prices. This all according to Bob Prince of Bridgewater Associates. That's the latest grim warning about the risks that we are seeing for this global economy at the World Economic Forum in Davos. Prince spoke to Bloomberg's Tom Keene and Lisa Abramowitz.
We think we're in a monetary inflation, which is a very different animal than what we've experienced in the last couple of decades. Recent inflation has a cyclical inflation is when you get a pop in the economy, pushes up against capacity constraints, inflation goes up. But money and credit are under control. This is a monetary inflation more like the 70s. It was triggered by the massive injection of money and credit by policy, which has now created a self-reinforcing process. Very high levels of nominal spending, 10% nominal GDP growth. I mean, it's a long time since we've seen high nominal GDP growth, right? So there are things happening now that people are not used to, because we haven't seen these dynamics for a long time. But the result of a monetary inflation is high nominal GDP growth, and then that gets absorbed by prices, and so you get low real growth.
Right.
And that produces stagflation, which creates a very difficult policy choice.
So do you think that the U.S. is facing stagflation?
We're headed toward it, yeah.
In the near term, in the next 12 months?
We're headed toward it.
I mean, you can game out what that looks like. I mean,
we are, you know, we're on the cusp of it, yeah. And it's how do you define stagflation? There'd be different ways, but basically the way we look at stagflation is in terms of how it affects markets. And the way it affects markets is if the inflation rate is higher than discounted and the growth rate is lower than discounted. And we're in a situation right now where there's a very low inflation rate discounted, therefore it's easy to be above that, and we've got a high growth rate discounted, therefore it's easy to be below that. So relative to what's discounted, we could very easily be into this very quickly.
What is the macro call right now for you and Mr. Dahlia?
Well, our whole team, you know, we shouldn't just, you know,
okay,
have it.
Patterson as well. Okay, move on. What's the macro call?
That the markets are under discounting the inflation picture. that the sustainability, the self-reinforcing of the inflation is not discounted. The degree of tightening over time is not discounted. I think within the stock market, even different types of companies and how they benefit or are hurt by a high nominal GDP, rising interest rate environment. It's a unique environment that you can't just take the average of the stock market.
Right.
You have to go inside it.
That was Bob Prince, Bridgewater Associates co-CIO, speaking with Lisa and Tom over at Davos. And you can see that really reflected in the markets as well, as you see company after company have to rethink their margin guidance, and that taking down their share prices and that taking down the overall market. You have the S&P holding on to the lows, but nonetheless still up by full 2 percentage points. Tech getting hit the hardest, down by 3%. The reason why that's also interesting is because you're getting a huge move into the bond market. So yields coming lower, but so is tech as well. Flip up the board and you can see kind of what is leading the decline. We know it. It's Snap. You got Meta, you got Google. All of those companies that are ad-based are going to be getting hit on this next leg lower of the margin recalibration. And the economic data, as we saw earlier with the Richmond Fed index rolling over, you have U.S. services and manufacturing PMI rolling over. We'll get your trade on this volatile market day. This is Bloomberg.
This is Bloomberg Markets. I'm Rishika Gupta. You're looking at a live shot of the principal room. Coming up, Ron Kaufman, the Petco CEO, joining Bloomberg Television, 2 p.m. New York time. This is Bloomberg.
For the moment, we are not seeing a recession in the euro area.
But clearly the economy is starting to weaken. But it really, to me, comes down to inflation.
Supply shocks, demand shocks, all together mixed in one. Of course, it is unclear at this moment in time.
We may see prices even going higher, being much more volatile, and becoming a major risk for recession for the global economy.
I worry about a recession. Eurozone and European Union will not go into recession. There will be a slowdown. But, you know, labour markets are so tight.
There is now an increased risk of recession, but we do not anticipate a global recession.
World leaders there weighing in on the recession risk from the World Economic Forum at Davos. Let's get right to this market sell-off here. The S&P down by 2.2%, trying to find a bottom here. Chris Murphy, Susquehanna Financial Group, co-head of derivative strategy, joins us now. You can't really see it, Chris, but the first gap lower was definitely the Snap situation as we opened lower. The second gap was the economic data that we got out right before 10 a.m., which showed that services and manufacturing rolling over, new home sales really terrible. What's the low here?
Hey, how you guys doing? Well, you know, I've been pointing out we have not even had an S&P close to close bear market of 20%. That's 38.37 and a quarter. So that's obviously going to be something that we're most likely heading towards at some point. We've had a couple bear market bounces to interrupt us, but we really just had much more of an orderly sell-off as growth is being repriced due to the Fed and things like that. You know, VIX at 30. S&P realized volatility, how much it's moving, also at 30. We're going to want to see that higher before we can feel comfortable about a bottom for this.
Chris, how much higher? Do we need to see VIX in the mid-40s before we kind of realize that things are really breaking here?
If you look back historically at a lot of the other times, that would be correct. Yeah, VIX around the 40s, you know, and that's when some, you know, new uncertainty would be introduced. You know, we have kind of had an orderly sell-off. You know, we're looking at inflation, growth is being repriced, the Fed is coming back. A lot of things are known right now, you know, for VIX to really pop. And also, we're really not seeing very impressive just volumes in general. To see a lot of turnover, we need some more, you know, maybe another shoe to drop.
In terms of, say, the dollar and yields, have both of those peaked now?
You know, it looks like they have. You know, as they starting to become the traditional kind of risk havens. So that's obviously going to help the stock market and equities a little bit. You know, so that's a fair point.
How much lower do we go, do you think, Chris? What does your gut tell you right now? We went into the pandemic at around, what, 3,800, 3,900 on the S&P. We're still trading way above that. We're at, no, sorry, I get my numbers wrong. We went in just below 3,400. We're now trading at 3,800. Do we need to unwind the post-pandemic gains for this market to kind of at least assert some sort of normality?
You know, I don't think so. I'm still going to focus more on, because that's what I look at, the VIX and volatility levels. But in terms of an S&P move, if you look at the 2018 parallel and the 2011 parallel, you know, you're a little more than 20%. So we're not that far off. COVID was obviously a different story, but it was also very fast. That's just assuming that the high end of the inflation tail is off the, is off the menu. If inflation doesn't calm down and continues to surge, then certainly a lot lower. But I'm thinking more like 22 to 25% off the all-time highs for the S&P.
So what's interesting is end of last week, we saw some call buying come in the triple Qs, which is basically the tech ETF, right? And I'm wondering, in terms of the options market, what kind of positioning are you noticing, particularly if you're looking at the VIX? Are we starting to position for more calls? Are we trying to position for some more upside here? Or is the positioning still kind of skewed?
You know, I think that Q's observation is a great observation. And I kind of look at it like this. If you were to look at call open interest in the Qs, it's exploded. And you're thinking, wow, are people suddenly getting bullish here? I'm not sure it's really that. I think it might more be everybody has taken down their positions. Everybody is degrossed. And if you're an investment manager and you don't have a lot of upside exposure, the worst thing that can happen is your investors are mad at you on the downside because the market sold off. And then they're even more mad at you on the upside if we rip higher. And who knows what's going to happen next, right? So if you don't have those upside calls on, you're setting yourself up for a potential bad situation if we do indeed rip higher in the second half of the year.
What are you seeing in single stocks? You're getting some really big names at the moment, Chris, moving around aggressively. Do we need to see, are we going to see more single stock volatility? I'm wondering where the kind of the epicenter of this is. Is it in single stocks? Is it at an index level? Where do you see the biggest kind of moves right now? And how should we think about those moves and the signal we get from them?
In terms of the signal, in terms of a bottom signal, I'm really looking at the index level of continuing to see broad everything selling off. We did see that in the consumer staples last week. That was maybe a sign we're getting closer towards the end. On the equity level, all those high growth tech names have already gotten hit so hard. I'm not sure what you're taking out of them right now. We're actually seeing a fair amount of volatility selling in some of the larger cap names, even Walmart after last week, Citi call selling after the big move in the banks yesterday. So we're still seeing some selective call selling in the individual names for people with a little bit of a longer term view.
You mentioned dabbling into some call options to not miss any rip to the upside. When you see upside, how do you measure whether it's just like a rally in a bear market sell-off, or if we're actually having something a little bit more substantial?
I'm just going to go back to, we're not seeing much volume and turnover just in general. We're not seeing a real spike in VIX term structure, realized volatility for the S&P. So until we see that, odds are it's a bear market bounce.
Fair enough.
Okay. In terms of the mix of institutional versus retail, what are you seeing right now, Chris?
2021, if you guys remember, we were talking so much about the small lot call buying, all that activity, the meme stocks, et cetera. We're really not seeing much of that right now. We're seeing more institutional. And if you were to look at, expiring positions, let's say May expiration that we just passed, we saw a lot more positions in index and ETFs than we had been seeing over the last couple of years. And less, still a lot of positions, but less of an extreme increase in the equity level. So it's really a sign that the, maybe institutional players, whether it's hedging or those upside calls in the Qs, they're getting more involved. It's obviously much more of a focus on the macro right now compared to 2021 when we were more focused on the micro.
All right, before we let you go, I just want to point out S&P sort of now on the lows of the session, down 2.2. We're at 38.84. NASDAQ 100 down by 3.3%. So it is getting relatively ugly out there. Chris, I know you're a derivatives guy, but when you come in the morning, sort of what do you look for? What's going to be another catalyst here? We weren't really expecting Snap earnings last night to be that catalyst. What are you watching?
You just said the Snap being the catalyst. Obviously, that's not good for sentiment. But if you think of Snap, for example, that's in it's not even in the XLC, which is the communications ETF. So I think we're going to see these moves that are, we're going to try to pin a reason on them, but it's really just the market that we're in, the volatility that we're seeing. When I come in the morning, I'm just looking at the VIX and the volatility, the structure of that. That's kind of the first thing that I would look at to start to, wonder if we're getting close.
Chris, thanks for jumping in. Really appreciate it on a busy day like today. Chris Murphy, Susquehanna Financial Group, co-head of Derivative Strategy. Sir, thank you very much indeed. Glencore stock on the move right now. Bloomberg now reporting that we are going to see a settlement with US and UK authorities into alleged wrongdoing by the commodity trader. Looks like potentially we could see some sort of a press conference a little bit later on today. US Attorney General Merrick Garland hosting a press conference this afternoon, 2:30 p.m. It's in Washington. It's on, quote, unspecified Foreign Corrupt Practices Act and market manipulation matters. So it looks like we are seeing some sort of news on Glencore going to come out a little bit later on. The stock was up a little bit more just a moment ago, up 5%. We're still up circa 2%. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. European Central Bank President Christine Lagarde rejects the idea that the euro area is heading for a recession. Lagarde spoke to Bloomberg in an exclusive interview at Davos.
We have the negative, the adverse, the various alternatives there on the basis of hypotheticals such as boycott of oil, interruption of gas supply that clearly would have a significant impact on the economy. But for the moment, we are not seeing a recession in the euro area.
Lagarde spoke a day after laying out her vision for the ECB's next steps. It's likely to exit negative interest rates by the end of the third quarter. In Russia, opposition leader Alexei Navalny has lost his appeal against a new 9-year prison sentence. He'll be transferred to a high-security prison that supporters say is aimed at isolating Vladimir Putin's top critic even further. Navalny was convicted in March of fraud and contempt of court. And American households are about to get some unwelcome mail, some of the highest power bills they've seen. Residential electricity rates are poised to climb even higher this summer. It's a combination of tight supplies of natural gas and coal, drought in the west, and a nationwide forecast for extreme heat. Barclays estimates monthly bills will be more than 40% higher than last year's. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alix, Guy.
All right, thanks so much, Ritika. So, Guy, that's going to be pretty severe if you raise those power prices. Here in New York over the weekend, it was 90 degrees Fahrenheit. That's about like 32 degrees Celsius before Memorial Day, which is nuts. And you get like, $300, $400, $500 monthly power bills. That's going to really dent what you're able to spend on other stuff.
Well, that's what you're beginning to see. This cost of living squeeze is manifesting itself around the world. The US, in the UK, it's interesting to see Europe holding up at the moment. I think if we were paying top trumps, I'd win this round, because here in the UK, our bills are going to be going up even more. So we've already had a near doubling of energy bills, and it was announced today by Ofgem. There were indications for Ofgem, the regulator here, that they're going to go up another 42% in October. That means in a year, we're up nearly 100%, Alex.
That seems impossible for people. It feels like they have to offset that.
The tide is rising, and as somebody said in one of the articles I read this morning, it's going to cause people to drown. Now, obviously not physically, but I think the financial stress is going to overwhelm people. And it's going to cause the government to have to do much, much more. There's a huge conversation here in the UK about whether or not we should be having some sort of a windfall tax. Look at what is happening with Drax today, SSE. Those prices are sharply lower because there is an expectation that the generators are going to get taxed as a result of this. But I'm not sure how that works. The long-term contract story is really difficult to untangle. Plus, you're asking these guys to invest more in the grid. It's a really difficult one to manage. I don't know whether that Ofgem story is designed to prevent a windfall tax or encourage a windfall tax.
And I also wonder, too, if you wind up tying it then to the manufacturing and services data that we wind up seeing, is factories at some point might have to stop. Like if you can't afford your power bill, or if there's literally not enough power to get to you, either one, you stop operating. And the knock-on effect of that. So the numbers we got today from the PMI, for example.
How much pricing power do you have? Can you pass on prices? The top line is going to be, we're seeing this time and time again now, aren't we? we're living in an inflationary world. Of course, the top line is going to be moving along quite nicely, but the middle of the P&L is where the pain is felt because that's where you take your costs. Profitability gets hit. That is the new leg of this. You would expect that actually the top line would continue to do really well. You've got to have pricing power. If you don't have pricing power, you are going to see reactions like the one we're seeing in Snap today, and that's where it gets ugly, to say the least. We'll carry on the conversation the next hour. Europe is by no means immune to this. The PMI data today out of the Eurozone on services I thought held up quite well, but for how long? The UK absolutely trashed Alix. Chris Williamson, IHS Market Chief Business Economist, is going to be joining us next to walk us through the data and give us an idea of what it ultimately means. Equity markets are certainly under pressure. The European close is coming next. This is Bloomberg.